This is interesting. We talked about the death of the 60-40 portfolio, stocks and bonds last year. All of a sudden now, bond investors look like they're doing pretty well. There seems to be almost a normality. Flight to safety, bid up treasuries, stock prices go down. Is that something that we can expect to see in the coming weeks and months as well?
Yeah, I think it's really going to be a theme for the year. Ultimately, the market really needs to move away, as long as the data continues to, provide us evidence that we can, from the inflation story and really talking about, the decelerating growth environment. Ultimately, you look at the fixed income markets and, our theme has really been, long, good carry. And go up in quality. And so that means more treasury exposure. It means more duration, within our fixed income portfolios. But you really don't have to look very far, in fixed income markets to find a lot of opportunity right now. Everything from the securitized side of things where, you can get, income that's 350 basis points over, say, an Amazon bond for a warehouse that is, being leased by Amazon, to, the credit side of things, both investment grade and below investment grade, where we certainly don't expect default cycles to be nearly where they were during prior recessions. So, like I said, long good carry. There's plenty out there, and these companies are in great shape from a corporate standpoint when looking at interest expense and their coverage of that.
In the past, when we've seen sharp moves lower, like we have in the Treasury complex, we know that there are some, a lot of factors at play. That the Bank of Japan was a big influence.
Yep.
We've got recessionary fears right now. But the level that we've seen it come off in terms of yields, well north of 4% for the 10-year, now to almost like that 3.4% mark, that implies a lot of folks are maybe cramming for the safety of U.S. government debt guaranteed by the Treasury. Is this a sign that recession is pretty much inevitable at this point?
Yeah, most definitely. I think, the dichotomy between the stock and the bond market over the last, 12 months or so has been stocks have priced in a soft landing to, a large extent for this year. But the bond market's priced in a hard recession. And so like you said, there's definitely some flows, especially with the strength of the dollar, investors coming into the United States to get those yields and the appreciation of the dollar, which was up about 12% last year, I think the highest in about 40 years or so. But, ultimately, I think, we were probably a little overbought at this point. If you take a look at the inflation data and what the Fed is projecting where Fed funds needs to go, sometime in the first 6 months of this year, and we expect them to likely pause sometime in May. That would imply a 10-year should be closer to 4.25%, relative than to, like you had said, with the 10-year inching lower than 3.6%. So might be a little overdone, but to your point, I also think it really feeds into the the recession narrative, which again we also expect this year.
You know what the one thing a recession can do is kill inflation, right? I mean, that's the whole idea here. Now, is this inflation story in your mind, is it done? Is it in the rearview mirror? Or are there still threats in the coming months for higher prices for consumers out there?
Well, I don't think there's necessarily, threat of higher prices. We'll start to see some of the lag effect, especially with housing start to flow through into the data. We've got it on the soft data side of things, but it hasn't necessarily flowed through into the hard data that we're looking at. But I think the inflation picture will, or at least narrative will soon change, and really how the wage growth environment will likely impact corporate earnings. Corporate earnings have been unbelievably resilient. Last quarter was the first that we saw since the first in 2020, where profit margins actually fell for the S&P 500. And most of it's really come from just higher costs of doing business as opposed to actually coming from wage inflation. And so although we've seen wage inflation slow a little bit, some more softness within the labor market, the Challenger Gray data recently had showed, layoffs were up about 400% from the year prior, which is coming off an extremely low base, granted. But ultimately, this softening should be, an encouraging sign for wage growth. And how that might impact, corporate earnings. But, I think now it's the reverse of what we've seen in the last, year or so, where you've been focusing on some companies in your portfolio that have been very exposed and have operating leverage that, would benefit from a rising rate environment, inflationary environment. I think you really have to kind of flip the script a bit, moving forward in 2023.
Okay, and before we let you go, one quick point here in just a few moments. What exactly is your outlook for the stock market in 2023?
Sure. Yeah, we're cautious. We think, ultimately 17 times earnings is probably a fair multiple with where yields are at. And I think, seeing yields in the dollar sell, yields become lower, the dollar sell off this year. Obviously, that's been, helpful for risk assets. But I think that we, are fairly wary. Coming into this fourth quarter earnings season, we've gotten banks, reporting thus far, but I wouldn't be surprised if this is sort of the kitchen sink quarter where companies really lower the bar for guidance for the year, ultimately throw all the expenses into the quarter, try to get those the bar lower just so they can jump over it later in the year. So I think by the time the Fed is done tightening, hopefully in the May timeframe, ultimately investors will be looking at 2024 and what the trough should look like for the economy, and ultimately the growth that may come from both top and bottom line in 2024. But
All
I
right.
think it's going to be choppy until then.